My name is Andrew Stotz from Stotz Investment Research, and I'm here at the offices of the fintech firm Phenomena, and I'm interviewing Mr. Tirasan Yะโพ Welcome to the interview.
Right.
Yes.
Thank you.
And Tirasan, I'm going to call you Zed.
That's my nickname. Correct.
Perfect. Okay. So you come from TMB Asset Management. So maybe you could take a moment just to introduce yourself, maybe tell us some story about your life and your experiences and what got you here.
I started working in the investment industry before the crisis in 97. So
where was your first job? Like what was the job and how did you get it?
My first job is government saving asset management, which at the moment, Thanachart Fund.
Okay.
Right. I'm looking for managing the money, saving deposit with the bank and finance, and then going to be crisis in 97, right? And then the fixed income fund going to be developing since that time.
It's an important point that I think many of the listeners may not realize, but prior to the 1997 crisis, equity funds were very popular. Fixed income wasn't so popular. But after the crisis, money all went to fixed income funds. And the legacy is that most funds in Thailand are fixed income, and most of the money in the mutual fund industry is fixed income. And I think that's probably the same also, that you guys have a large amount of fixed income.
Yes, a very good brief for fixed income industry since then.
Right. Yep. So people were looking for safety. So tell us a little bit about your firm and kind of what makes it different. What types of products do you offer?
Because of our company started when the crisis happened, right? So we are very conservative in terms of the investment, both on credit and risk. So from time to time, we are trying to add more risk to the fund, but because we are very conservative, we cannot add more risk on that. So in terms of in Thailand, universe in Thailand, we are quite very small. So we're trying to find more opportunity, more than in Thailand. So we are going to other countries to find better risk-adjusted return. I think that's why we are at the beginning. I think we are really not that efficient because of the credit risk. We are very conservative, but at the moment, I think it's very good because it makes us trying to be different than from others.
Right.
Going from abroad, going to see what is give us better risk versus return.
Got it.
Yeah.
Okay. So you're able to provide investors with alternatives outside of Thailand.
Correct.
Through these foreign investment funds. Okay, great. Well, maybe tell us a bit about your own style. Like, what's your view about fundamental versus technical, and your companies? You know, how do you guys think about the difference between the two?
As I said earlier, we are quite conservative. That's why we are very focused on the fundamental of each asset class or each security that we have been investing. We would say that we use technical analysis as well, but not that deep as in equity things. Only demand, supply, volume, sell, buy. So we use that coupled with the fundamental to add value to the investor.
Got it.
Yeah.
So you wouldn't be investing using technical as a strategy. You would be using it as a tool. So you may find fundamentally companies that you like, and then you look at price movement, you look at volume, you look at those types of things to tell you how and when to add or get out of a position.
And in addition, I mean, the fixed income in Thailand, mostly they are very segmentation. So if we know each segment very well, then we can move around and make advantage on that.
Got it. Right. Got it. And for people, it's interesting to think about, like, what's the benefit for an individual to own a fixed income fund, whereas someone may say, oh, I'll just buy a bond from a company, just one bond, or from the government. What's the benefit of investing in a mutual fund of fixed income?
Yeah. I would say if it were me, and I already do that for me as well, I have a bond myself and I have a mutual fund as well. So I think I would say that it will complement together. It depends on how you allocate your money. If you are allocate on long-term investment, you can put money in your in your bond, the physical bond yourself,
Right.
and you are making return from the coupon, from interest rate for like 5 or 10 years. A short-term money, for example, you have to use money in 6 months or in a year. You cannot buy a bond because of when you sell, you don't know what the price will be, and the market is maybe not accommodating you at that time.
Right.
So if you have another money that have to like use very in short term, I would say that I would prefer to put into the mutual fund because it provides you liquidity and diversification.
I think, and that's a critical thing because with if you're not a rich man or woman and you don't have a lot of money but you want to put it into some fixed income, if you were to put it into an individual bond, it may take all of your money. Now you're exposed to the risk of that one company having a credit problem.
Yes.
And a mutual fund allows you to take a smaller amount of money and get the diversification benefit.
Correct.
Got it.
Yeah.
Okay.
It depends on how much money you have and then how to allocate your money.
Right. And it's interesting to think about, I would be curious what your idea is about, is the market efficient or inefficient in Thailand and in the fixed income market? You know, is there benefit for someone to be passive versus active? What do you think about market efficiency for fixed income?
Yeah. I would say that the efficiency will be getting better every day from now because we have internet, we have like phenomena, we have information very good, but sometimes the information cannot get to the people that make decisions. For example, if there's something happen now, I have to interview, right? I cannot get to the desk. So I think there's still some inefficiency to the market. So we can have benefit from that as well. But yes, it will be like minimal from now on.
Got it.
And from the passive or active, in my experience of managing portfolio for fixed income, I think 80% is come from the market. We can add only 20 or 30% to the alpha of fixed income fund. That means that I still think that passive is still a good thing. But if you want anything more than that, you have to go to active fund. But purely active fund may not be good for a long time because of some fund managers may be good this year, maybe not good next year. So I think it's a combination of passive and active.
Yep. Okay, that makes sense. Let me ask you, how important is risk management? And how do you think about risk management yourself or in your company?
Yes, first of all, risk management is very important. I think everyone could agree with that, right? But the most important is that if you don't take risk, that may be even more risk. So in the past, we have been avoid the risk, and that create a risk of underperform. So what is best is that you have to take what is best for your company and best for the fund in terms of the risk-adjusted return. For example, if we investing in only credit rating that A rating, probability of downgrading will be more than upgrade because our company may not going to be easy to upgrade to AA.
Right.
But if you invest in BBB bond, you maybe have a big chance of the upgrade if you choose the correct one.
Right.
So this is a very important that when you choose the investment. So avoid the risk may be not good in the long term, but you have to be very careful.
So I suppose that a main part of your job is the idea of analyzing companies and thinking which ones are going to be upgraded that the market hasn't seen yet.
Yes.
And you think, hey, this company is getting better, this industry is getting better, this company is getting better. And as it's more profitable or its balance sheet's getting better, eventually it's going to be, the rating's going to increase.
Yes.
And that's going to give us a higher return.
Correct.
More people are going to want that bond. They're going to bid up the price of that bond.
Yes, that's right. That's right.
That's good. That's a good, simple way of understanding it. Let me ask you, because I have a lot of young students in my valuation masterclass, and they want to learn valuation and they want to learn to be a fund manager. They're looking at equity, they're looking at fixed income, but I'm just curious, like, what would be the successful traits of a fund manager? What would it be that makes a good fund manager?
A very difficult question because I'm thinking about this for a long time because of many of my friends ask. I think what they in this industry for a long time. I think because of I follow the information every day. I mean, for example, when I get back home, I'm always watching CNBC, Bloomberg. Maybe half an hour or an hour is enough. You can go in to watch your favorite ละคร but at least I have some time to watch that and follow the market every day, and you get used to it. Morning, you first thing you do is that fly with your phone and looking the news, what's happening, and what will be you're gonna do when you arrive at your office.
Right.
So you think about that before you going to the desk. So save your time and then you implement that very early because of early market is very good for everything.
So you'd have to be the type of person that likes to be on top of the market.
Right. Yeah,
And you can't walk away from it and say,
yes.
oh, I know I'm tired and I'm just gonna not pay attention for the next couple of days because I want to work on some project. You can't do that.
Yeah, you have to follow the market all the time.
Right.
Maybe it's not that because it's entertaining for me. When you have a position, right? When I have, for example, we have position in UK gilt, government bond, and we follow the Brexit news every day, and they change every hour. When we have position, we have to look after that. That's a very
And would you also say that it's the desire to learn? Like, because I mean, you're learning new things all the time. You know, one time you're thinking about Brexit, and then another thing comes up, and now you got to look at that. Is it? Do you have to be open to learning new things all the time?
I think everything has a basic understanding. Everything will be the same. It will affect your portfolio in not good or bad way. So I think ability to understand or learning or willing to learn, I think is very important.
Right.
Every time, I mean, all the day, not only the day that you are at the desk. Sometimes I am not at the desk. I just walk around and think about what will happen.
Right. And one other question about that. It sounded like you were saying that even though there's many things happening around the world, there may be a lot in common. Like there may be some foundational things like, okay, is this good or bad? Or is this going to increase interest rates or decrease interest rates or that type, or currency or that type of thing? So it sounds like what you're telling me is that you have some framework that you have developed to look at things and kind of look at the first pass to make a judgment, and then later you learn more about it. Is that be correct?
Yeah, correct. And that's I would say that's come because of the experience. You have to be in the market long enough. That is what we cannot learn in just overnight.
Right.
So one of my favorite phrase is that experience make a difference.
Experience makes a difference. That's a great one. And for the young people out there, I think a good lesson is if you really want to be a fund manager, start following the market now.
Right.
Start following it and seeing what's going on and trying to learn from it. That's a great piece of advice. Let's I want to ask some personal things about your own development. Like, who was the biggest role model for you when you were starting out in the investment world? Like,
actually, I don't know, everyone knows Bill Gross. He's the biggest bond king.
Bill Gross.
Bill Gross, PIMCO, right? And he's come from nowhere, right? And he's lived the PIMCO with a very famous and very good performance. But then, when he going to do his portfolio at Janus Capital, he did not do very well, right? So I think what I learned from this is that if you want to be good, you cannot do alone. You have to be teamwork and have to be careful about the risk, because maybe misinvest in terms of the risk when he doing it at Janus Capital. So that's all. I think my role model is that he's good, and then he left, and then he doing himself, but he don't have any teamwork.
Got it.
Yeah.
So the needing teamwork, I think the other part of it that I've learned too is the brand and the infrastructure of the company adds a lot. When I went to work for CLSA, as an example, the brand and the infrastructure provided a lot to me and taught me a lot.
Correct.
I was a focused fundamental analyst, and then they really kind of pushed me to get out and be more talkative and more out with my ideas and stronger with my ideas. So I definitely know what you mean.
The platform, the everything.
The platform. That's the best. And let me ask you about one of the funds that you have, the TMB Aggregate Bond Fund. maybe you could just tell us what it is and what benefit a Thai investor would have investing in that compared to another fixed income fund or
The name is show itself is the aggregate bond fund. It means that we aggregate everything into the fund. So we're trying to go to other countries as much as we can, but with the very good credit. So the first reason that we are going to abroad or foreign investment is to trying to get better risk-adjusted return. So any paper that have a credit rating higher than Thailand, it should be okay, right?
Okay.
Yeah. But we trying to see more on the trend of the interest rate. For example, if we seeing the cut rate in Australia, we're going to buy that bond to get the return on the Australian government bond, for example. So the fund can have more opportunity to get the return rather than from Thailand. But I didn't say that Thailand is not good. We are good, but sometimes we have to diversify out to find some extra return from other country as well. That is the main reason that this fund trying to do. I would say that it will be like a multi-country investment, which we are not like we are fully hedged into Thai baht, which means that you don't need to worry about the foreign exchange.
So that's a good point too about the foreign exchange, because sometimes people are afraid about investing abroad because they say, well, what if the baht keeps being strong? Then I'm not going to make any money when I translate that money back to Thailand, the Thai baht. But what you're saying is that you're fully hedged. And that means that basically when someone is investing in your fund, they're getting exact exposure to the underlying assets, meaning the fixed income, the bonds that you are buying in those other countries, but not the other countries' currencies.
No, we are not playing on the currency because of it's very difficult and it will be a lot of volatility in the fund. So we're trying to minimize the volatility as much as we can. Because of when you seeing the fund have very volatile, then it's not good for investor.
Right. And I guess this would be a feature of the fund, of this fund, that is beneficial for the individual investor, because if an individual investor wanted to invest outside of Thailand, even if they wanted to buy a bond fund outside of Thailand, the cost of them hedging their Thai baht position would just be way too high. But you have, because you're related with the bank, you get good rates and you're going to be able to negotiate better rates. So the cost of the actual hedging is much lower than an individual. Would that be right?
Yeah, correct. And sometimes individual cannot
even do it.
Themselves. Yeah, because of the bank have given their credit.
Right. Okay. So another question is, what do you think is a good allocation for, let's say, a 30 or 40-year-old person? Should they have 100% of their money in the stock market? Should they have 100% of their money in fixed income? Like, this is not for a specific recommendation, but just to help people understand what role does fixed income play in a portfolio.
Yeah. Even I'm a fixed income fund manager for a long time. I prefer equity. Right. Yeah. For my own portfolio, I put in equity more than 50%.
Okay.
Yeah, and maybe I'm too old. I'm like more than 40s. But if you are 30s or 40s, I think you better have a position in the equity because you have a long-term horizon. Right. And if you're going like invest more than 10 years, it will pay off you a lot. But the fixed income maybe give you a cushion when the equity is not failing you. Sometimes, some days, some years, equity going down 20%. Fixed income may help that to like a bumper. Trying not performance of your portfolio is not that good.
Right. So it's some and when people talk about interest rates, which I'm going to ask you the last question, we're going to talk about interest rates and the yield curve. But people say, oh, fixed income bonds go up and down a lot. I always show them the long-term changes, and you see that, it goes up and down, but it never goes up and down like a equity fund. So that's a key component of it. I think the point that you're making is a valuable point for young people, which is you really want to capture the long-term return in the equity market and use fixed income as a tool to manage the portfolio overall. Okay, so let's talk about recently the U.S. Yield curve has inverted, and we've just got so many things going on in the U.S. fixed income market and government debt issuances and all that. I'm just curious, like, what is your the way you look at the U.S. and how important is the inversion of the yield curve or just U.S. interest rates in general for us in Thailand?
Yeah, I think it's a very difficult question because of there is not many times that the curve is inversion in the past, and it's a long time ago.
Right.
Because of we are in the new normal, people saying, right?
Yes.
Yeah, we have a lot of money in the system. The U.S. the government printed a lot of money, right? Even they are stop the QE, there is still money on the system. So I think what that at the moment U.S. curve inversion is because of first the money is a lot, they can't go anywhere. They don't want to put in the equity, so they're buying U.S. Treasury for safety. So that's one reason. Second reason is that the interest rate of U.S. in the past going up too much. So it reflects that it have to be going down.
Right.
But I don't think that it will be a recession in U.S.
Okay.
Yeah, that's just my interpretation because of the money is a lot. So for even me, I'm putting the fixed income more than equity at the moment because of I don't see the growth in equity.
Right.
So I don't think that will be resolved soon. It will be continue to invert for a long time.
Right.
But it's not strong recession. Maybe a slow growth in the future, like 5 to 10 years.
Got it.
Right.
So part of what I'm hearing also is that maybe a lot of money has already gone into U.S. equities, so more money is not going into U.S. equity, and for security, maybe some of that money is being allocated to U.S. government bonds. Yeah. So that's a wrap on another great opportunity to learn about the mind of a fund manager. This is Andrew Stotz from Stotz Investment Research from the offices of Phenomena.